Welcome up our real estate panel. We're going to start. So DJ, I'll go ahead and turn it over to you, and hopefully we'll get the mics all working well there. And if you want to maybe just do a quick introduction of the topic real quick, and then we'll go through some introductions.
Yeah, so we're going to go over family office real estate investment. I run panels a little bit differently than normal. One is, rather than the end asking for questions, I like to open it up. And so I'll occasionally ask if you have any questions, because we are here for you to answer things that you might want to know. And then I also encourage you guys that if somebody on the panel says something and it brings you to have a question, that you actually, you ask yourself. So you guys have heard a little bit about me. Let's start at the end. Tom, why don't you tell us about you, who you work for, and a little bit about you.
Hi, I'm Tom Hoban. My brother and I, Sean, started a family office about 3 years ago after actually attending a few of Nathan's great events here. We've been Keiretsu members for 4 or 5 years. I have a different way of introducing myself after the way these speakers have sort of described family offices. I've spent a lifetime punching above my weight, and if I were to look back into our family office, I'd say we built ours more for the soft needs, maybe, DJ, than the hard needs. We certainly have plenty of hard capital we're managing, but as I'll describe perhaps in some of my answers, 2 sons and a daughter in their 20s. My brother has 4 daughters in their 20s. We kind of ran our operation like a mafia shop. I never talked about work at home. So at some point we have to get them exposed to this this stuff that we've created. We made most of our wealth in this first generation experience in direct invest real estate. We're here in part because our sponsor group, Coast Equity Partners, is here inviting family offices to co-invest with us.
I'm Bruce Galloway. I've been doing real estate since 1981. We've created a family office where we own neighborhood shopping centers, apartment buildings, and raw land. Done well over 100 projects in my life. I originally started out in Southern California and have in the 90s branched out into the Denver market and the Phoenix market, and now we do projects in Phoenix and a number of projects in the southeastern part of the country.
My name's Jonathon Lewis, and I've been lending money on real estate since 1985. Over the last 10 plus years, I've invested our family's trusts into real estate in multiple different investments. Currently, I'm operating JLJ Capital. We lend, invest in real estate, so we have more of a debt perspective, and I've run I've run several multi-billion-dollar operations in lending, and currently we've probably lent about $250 million in the last year and a half, 2 years in real estate.
My perfect day is learning, and I want to acknowledge what Brianna and Nathan and Juan and Maggie and the team. Make sure you thank them today and tomorrow. I mean, this knowledge today has been powerful. My name is Randy Williams, founder and CEO of Keiretsu Forum, also GP of the family of funds, which Nathan is our CEO, Keiretsu Capital, which includes real estate, blockchain, and then topping off our best deal flow that emanates not only from the Northwest, but globally. And I look forward to engaging and participatory, obviously, a chat this afternoon.
All right. Jonathon, I'm going to start with you. As I mentioned when I was presenting that families have been moving toward lending more, a little bit more than the equity over the last year and a half. In relation to your businesses that you've had with the lending side and now doing it with your family office, is there a different strategy on what you will lend against, or where, or how much, or what LTV, or anything like that?
Well, the fundamentals are the same in terms of discipline and risk mitigation, but there's a great difference. When you're working in a publicly traded bank, you can't afford to let a loan go 30 days late. You just can't. So therefore, the type of people you're lending to, the rates you're giving are much lower. The reason family offices, I found, are in the lending is they're looking to get some sort of yield better than 2% or so on their money market, And if they're comfortable in real estate, they find that that's a good place to have a first lien position.
But are you more aggressive with your family money than you were in a business? I understand you had limitations, but.
No, we're just finding different types of opportunities. For example, we did a $16.5 million loan on a piece of land across the Hudson that has to be entitled, that the person paid $33 million for and does not produce income right now, and he has another $3 million already invested. So we lent 16.5. We held back $4 million so we could put more structure on it as a family office, and we're being paid 9+ LIBOR, which is over 11%, with a floor. It was a floor of 11, and we got 1% in, 1 out. And after 9 months, it goes up. So we want him out. He's a very wealthy person. He's worth about $60+ million. The piece of property is just one of 2 left on the Jersey side below the George Washington Bridge in what's called the Golden Mile or Golden area of the New Jersey waterfront. And I know for a fact that if something went wrong and he can't get us out, we can sell the loan very easily at par, and there are plenty of people who'd like to own that property.
Yeah, and one of the biggest things I think that can be a takeaway is family office, and we've heard this before, family office capital is patient capital. So you can afford to wait a little bit longer than normal and even ride through some of the troughs. So Bruce, I know that you recently had sold off your company and now you're doing some personal investing, and you're also having some families co-invest with you on various opportunities that you have. This is different. This is actual traditional investing, I would say, rather than lending. Is there any differences in your parameters now that when you had before with the business, now that you're using your own personal capital and allowing other families to co-invest?
Previously at Pacific West Land, we created funds, and the last 2 funds we did were more income oriented, where the goal was to find, and we focused on neighborhood shopping centers, and the goal was to find something that would throw off 6 to let's say 7% in cash flow, and then over the holding period would appreciate at least 3%. So we were shooting for a better than a 10 IRR. Now, personally investing money, we're looking at multifamily development, which for me personally, it's a way of balancing out. Right now, I get most of my cash flow and a lot of my equity is in neighborhood shopping centers, and living here in Seattle and being aware of the Jeff Bezos effect on retail. I can give you an example of a shopping center that we bought in 1993 from GE Capital for $1.6 million in Colorado Springs. It was about 65,000 feet. We still own that property. I looked at how much the rents have appreciated over the last 25 years. It's been less than 1.5% on average. And I guarantee you that an apartment building in the same area, the rents have probably appreciated more like 3 or 4% per year. And that applies across a lot of the holdings we've had. So but the market reflects that. If we sell the shopping center, we would probably sell it at an 8 cap, whereas the apartment building might sell for a 5.5 cap or a 6 cap. That's the market saying we don't see much appreciation in the retail property, but we think the multifamily has good appreciation. And being more entrepreneurial, we've done some value add deals, which is buying existing properties and trying to create value, but that's a very crowded space with, in my opinion, less disciplined money than the people that are competing to do ground up development. And that's where we've been putting all of our energy for the last more than 2 years.
Got it, yeah. So when you look at where the wealth is created for families that have created family offices, the number 4 on the list is real estate. And if you look at where the second area of wealth creation has been after they sold off their tire company or whatever, it's been real estate. So obviously that's a great area to create wealth and maintain wealth and build legacy wealth, right? So Tom, what suggestions would you have for somebody that's wanting to build a real estate portfolio? How would you recommend that they go about it? Where would they start? What type of property type, size, etc.?
Yeah, so most of the family offices that co-invest with us, who really became the examples that kind of we wanted to be like, and informed us a bit on forming a family office of our own. You know, there's sort of this idea, at least this is what attracts them to us, and I don't mean this to sound like I'm soliciting, but this idea that we all need shelter, right? So that's the simplicity of this real estate business. It's just roofs over the heads of people where they work or where they live. And so there's something comfortable about that. It's sort of like ag, and I don't know, everybody needs tires and everybody needs a place to stay. So what we find is people that are drawn to us have some understanding of that, some experience in their first generation wealth creation, something where we have a difficult time moving people over. They might understand it from an allocation standpoint, but if they made a lot of money in tech, which is a lot of the wealth around here, the jump over to this very sort of simple baseline, we're in the shelter business over here, it's safe, it's the get rich slow program. That is a big leap for them. So we're having conversations now around how do you see real estate? What is it? We're really providing a service for families in the workforce housing category we're in. Do you care about these families? Do you understand what happens down there? Remember, everybody's got to go home and sleep somewhere. So if you're interested in that category, then we work our way back into what we do.
Yeah, I think, in fact, in our report, the biggest category that family offices wanted to invest into, it's like over 70% is multifamily. And you know, when you start getting into workforce housing, that's really one of the recession-proof property types, which is a good area to invest. I personally think that if you really want to shoot the gap, you take a look at senior apartments as well. I think there hasn't really been a focus as much as there has been on the multifamily, I guess the traditional side, and especially because of the millennials, which continue to get brought up all the time and not buying homes. Of course, that's starting to shift a little bit. So Randy, you said that one of the things that you work with in Keiretsu has to do with on the tech side, right? So I did a keynote at a couple places before, and I said, look, I want to do it on real estate. And it blew me away. And what I took out of that was that the whole landscape in real estate is going to be disrupted to a point that nobody has a clue. And that's from attorneys to accountants to title companies to banking to lending. And the biggest component of that was in the blockchain area. What are your thoughts about, blockchain in general, maybe how it relates to real estate, but I think that the concept merely of blockchain, a lot of people hear about that vernacular, but maybe not understand it and why it's so powerful.
Well, we're talking about obviously investing in real estate, but my background is real estate, and that's one of the reasons I started Keiretsu, because my lack of discipline and expertise in the tech sector 20 years ago, and we're celebrating our 20th anniversary now. And so I want to introduce real estate as an asset class from day one, and we're blessed, getting back to your comment about senior housing, we've invested in the whole ecosystem from industrial, which I absolutely love, to multifamily, to senior housing. The blockchain arena is that a lot of us aren't smart enough to know what's next to blockchain, so we are in the fund-to-fund business there. Matthew Lamoureux was co-general partner with Nathan and myself. He's identified 8 sponsors we're investing right now. So we're always looking at fintech. We're looking at disruption. Speaking of disruption, is that we always talk about location. I always say GP. So I always look very carefully at the GPs. If it's a blockchain GP, it's a real estate GP, that's critically important to all of us. And I always think it's disingenuous. We talk about our wins. Let's talk about what we've lost money in and what we've learned from it. But the GPs are critically important on the success and or failure. So we are experimenting, and we're all in on blockchain. We've raised $8 million. But we have not seen the seeds come to fruition yet. We think we're going to have liquidity events the next probably 1 to 2 years. But getting back to our real estate access fund, which has realized returns, and we're at right now 15%. But we're going to probably decline that because we're not looking forward. But we think there's a lot of opportunities next couple of years in the recession, which I'd like to talk about possibly later. What are we seeing? What are we sensing? How do we prepare for it? But that gets back to GP and how do we trust, how do we look at, and what have they done? And it's fascinating, you know, when I always ask the questions, one, do you have skin in the game? And two, what are your losses? And, you know, really dig it out of your brain. What have you lost money in? And I've lost money prior to Keiretsu Forum. I can't tell you all the ways I lost money before I started Keiretsu. Now, my wife and I have made, we're up to 55 investments at Keiretsu. We're about 34%. We used to be 38, went down this last couple of months for a myriad of reasons. But, you know, use your communities, use your family offices to help each other be better investors. And blockchain can be really risky. You know, I mean, obviously we have a lot of great friends that come in from Australia, a lot of other places of the world. They're looking at crypto. We're looking at it differently here because SEC rules and regs. But blockchain, right, is a clear path towards something. We don't know what that is yet, but we are backing GPs that are really strong in that arena right now.
I'd like to just add to
Yeah,
that. We had a saying at the bank, and we have it in our company. We bet on the jockey, not the horse. Meaning if you have a good operator, you have someone who has a good vision and a good specialty and a good talent in a good area of real estate, go with them on that. And then look, secondly, at the property, which is very important, and check that out. But if you have a good operator, you're going to get good results with good track record, and you look back on all their successes and failures. If you got someone who's bad, you're going to find out pretty quickly. It's pretty apparent. There are the warning signs.
Yeah, and
I'll give you an example of, we bought a property in downtown Los Angeles in 1987. It was an empty 90,000 square foot building. And the point is, our vision was completely the opposite of what turned out to be the way to handle the property. So you want an operator that can kind of recognize the mistakes and correct them. We bought the building to be ground floor retail, upper floors garment manufacturing. Turned out it was too expensive to create the elevator access for the garment manufacturing, so we went with artist loft. And we projected we'd get over $1 a foot on the ground floor retail. We still aren't there, almost 30 years later. But the artist lofts have taken off, and the building that we bought for $1 million, we just kind of laughed at an offer for $20 million for it all these years later. So it's
makes up for that less than $1 per
You never
square
know.
foot,
Okay
right?
to be off.
you might be wrong, but maybe you want to be wrong in the right place.
No, I agree 100% about the GP. I've written a number of articles about that. I bring it up all the time. It's that, you know, the deal's secondary. If you can't get through the GP and you've got confidence, they've got a track record, you ask the right questions, the deal doesn't matter. And so I agree with you wholeheartedly about that. Does anybody, go ahead, sir.
And then also the wonderful companies here, a lot of our portfolio companies here, ask them what kind of skin in the game they have. And also, if you're going to be investing, I love milestone investing after they make obviously their you know, they articulate what they're going to do and they do it. Ask them if they're investing again with you, because that's very important. I love skin in the game, and I look very careful with GPs. Put skin not only now but in the future.
I think one comment though to your point is that the skin in the game is going to be all relative, right? 200,000 for me could be a tremendous amount, right? For Bruce, you know, 10 million could be a pain point for him. So it really depends on you know, what that GP, what makes them hurt, because that's sort of what you want to make sure they're not going to walk away per se. Anybody have any questions before we go on? Any questions that you want to ask about real estate in general? Go ahead. You know? Nobody? Okay. Oh, there we go. Go ahead.
So the old saying in real estate is buy low, sell high. So tell me what you project into the future in 2020.
Well, I'll tell you one thing. I'm blessed.
We're going to go down the line, and then I'll tell you what I think, and I'll give you the answer.
Getting back to the GP stack, it's just really important. You know, obviously the jockey is critically important, but I'm all in on real estate, on industrial right now. We're blessed to have 1 million square feet. We just got another 1 million square feet of refrigeration craft line, so it's credit tenant. But we got turned down by Amazon. We got turned down by Costco and a couple other, and we were 100% vacant. But now we have a 10-year lease, so I want the recession to come, especially for industrial, if it have long-term leases. So yes, what are we looking for in the future? We're looking for distress. We're looking for the next couple of years picking up industrial. But if you own, obviously, multifamily, you want it over 92, 94, not percent plus with ups. But conversely, when you have industrial, it's fully leased. Wow, how special is that?
Yeah, but I think she's asking, where do you think we are in the cycle?
Oh, I think we're probably, depending on what vertical, but I would say probably 7th to 8th inning. You know, we're blessed. I'm from Northern California, and I think we're in 4th inning there. But if we're in Ames, Iowa, we might be in 8th inning. If we're in different locations around the world. But so that's a tough question to answer. But I'm trying to prepare. I'm looking forward to the recession instead of looking, you know, negative about it.
First of all, we're looking, since I'm on the debt side, we're looking at NPLs now. We see an increase in NPLs. That's non-performing loans. So it's going up. The only thing holding this whole thing together on this piece is that rates have been so low for so long, it's allowed people to make a great deal more money than in a normal 10 or 15-year cycle. It's been very unusual, and it looks like it's going to continue for a while. That being said, cap rates overall are very high. Doesn't mean there aren't opportunities, but you have to look hard and long to find them, and it's very hard to find them. So as an investor in real estate, I'm sitting with a whole bunch of capital on the side right now that I'd love to deploy on the right opportunities, but it's just very hard. We just bought a GP interest, 50% interest in a GP interest. It's a triple net lease to Comcast. It's their call center in Tucson, Arizona. We like the cap rate we're coming in. The reason it was, we think, a little mispriced is the fund had to get exit, which is always a good story. And secondly, the lease, although Comcast is a credit tenant, only has 7.5 years left on it. So that creates a little room in the market for getting some extra pricing. We look at the asset very favorably. It's for the entire U.S. Spanish call center. So I'm just giving it an idea. There's still deals out there. I have 3 or 4 on my desk right now that we're looking to make investments in. One's an $11 million check, pref equity, GP interest, and others 4. We do both lending and investing, both for ourselves and my trust, but there are lots of opportunities. You just have to look real hard, and I'd stay away from some of the hot markets. I love industrial too. I can't get enough of it. I just can't find enough of the really good stuff. And it all goes back to the same thing. You've got to find the right GP or the right operator who has the experience, expertise, and can find those opportunities or those diamonds in the rough, if you will, that no one else kind of sees. There's an expert in a very specific market. Love Kansas City right now, just as a little shout out for housing.
So, Bruce, where do you think we are in the cycle?
First of all, I've been through 4 cycles so far, and in my opinion, we're very late in the cycle to the extent you can generalize. And some cities move at different paces, but let's say looking at multifamily, I was telling people it was too late to invest in multifamily in 2015, and I see properties that are selling for more than 2 times what they were selling for in 2015. So paradoxically, I think it's actually safer to be doing development because I'm buying pieces of land that have definitely not gone up as much proportionately as some of the value add deals. And if it's done right, I've created maybe a 30 to 50% margin of safety. So when the market corrects, yes, they'll drop in value, but I've got that margin of safety from the development spread. And also, when I started out in real estate, I thought like, well, in a downturn, people will gravitate toward the lower rents. What actually happens is people gravitate towards the better quality properties. So the rents drop in the better quality properties, but people upgrade. And so someone who's buying a value add property in a C area with 75 or 80% leverage could, if the recession hits when their loan comes due, they're going to be the next round of REOs.
Tom, where do you think we are in the cycle?
Yeah, so if there's 4 quadrants somewhere between, the 3rd and the 4th, I suppose, depends on the market, depends on the product type. So I care and I don't care. So you're looking at someone who spent 32 years managing other people's property. We have a large property management platform. In 2004, when we decided to go into the business ourselves and start direct investing, we were able to look at all these product types and do random 10-year slices looking back and say, well, which of these was cycle agnostic? Which product type, using certain assumptions, would allow me to not have to worry about whether I was buying low and selling high? And the answer was multifamily workforce housing. So I'm in it because it was the most cycle agnostic category I could get into. That doesn't mean there isn't competition, supply and demand. I will just add this as just a fellow who's been down there grinding, operating these assets and mining them for cash for years. Catastrophic events, world events, weather, political, these are the things I spend my time worried about. The supply-demand stuff's pretty easy to track. There usually aren't dramatic changes there. And just one little quick story, the biggest ass-kicking I've had in my career was when the terrorists decided to use airplanes, and 2 of my apartment buildings in the shadow of Boeing sent a third of my building home to Oklahoma because there was no planes to build with the carve-outs inside the contracts for riot war and all that, right? That's the stuff I worry about.
All right, I'm going to give you a direct answer for this whole thing. They are right that different property types move in different categories and et cetera. But from a market cycle perspective, you can go back 250 years, not only in the US, but the UK and Australia. And it runs in 18.5-year cycles. So when you're coming out of the recession, you've got about 7 years. You're going to see a little bit of dip, which will last only about 6 to 9 months. And I do believe that we've actually started to see that. You had mentioned that you've seen some of these non-performing notes. I looked at a couple deals. One was in Dallas. It was a Class A apartment. 2 were nearby. They were 98% full. And yet this developer came in and he was buying it for $60 million, which was the cost from somebody else. They were only 25% leased. And so they're buying it because he got over his skis. So I think we've already seen it. And like Sam Zell said, he goes, you know, did we start to come out of the recession in 2010 or has it really been 2012? Well, you look at 2012, which is probably really where you'd say the start was. It's 7 years in, we're at 2019. So we'll see a little downturn, and then we're going to see an increase happening, which will probably start in about 2020 and 2021. And then the next 7 years will be a greater increase in growth than the last 7 years. So we're going to see a much greater increase happening. Then in about 26 or 27, we're going to hit another major recession, an actual recession. And that's really what you got to be aware. It could be 28, 29, but history continues to repeat itself because developers get greedy and they start building, and it's based upon greed and not fundamentals. And we're people. We forget. So that's typically what happens. So that's and I'll go on the record for that. I think I am going to take.
We've got you on video there, DJ.
So we're going to have to stop for now. We've got a great panel here. If you have any questions, please come up, get their cards, ask them questions, and thank you very much.
DJ, Perry,